if the dollar loses reserve status, gold could surpass $39,000. And it says, what if gold replaced the U.S. dollar as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price target for gold. And if they were to divide central bank MO, which is the most immediate form of money in the system, they come up with $39,000. If they use M2, it's $184,000.
The potential for gold to surpass $39,000, or even reach a staggering $184,000 per ounce, is not merely speculative fantasy, but a mathematical projection based on the US dollar losing its global reserve status. A recent analysis by an emerging markets bond team attempts to value gold by strictly matching central bank money liabilities to physical reserves, effectively calculating the price required for a hard money reset. If the calculation uses MO, the most immediate and liquid form of money in the system, the price of gold must revalue to $39,000 to balance the ledger. Andy Schectman, president of Miles Franklin, notes that if the valuation model expands to include M2, the target price jumps to $184,000 per ounce. He notes that while MO represents only the narrowest form of currency in circulation and reserves, M2 encompasses the broader money supply, including savings deposits, money market securities, and mutual funds. By anchoring gold's value to this aggregate figure, the model reveals the sheer scale of unbacked paper claims, demonstrating that covering the banking system's total liabilities would require a price appreciation of nearly 7,000% from current levels to restore full solvency. This disparity underscores the magnitude of the disconnect between the financial economy and tangible assets. The analysis suggests that the current gold price is artificially suppressed by a fiat paradigm that has severed all ties to value. As de-dollarization accelerates and central banks accumulate metal at record rates, this shadow price of gold represents the inevitable reconciliation that must occur if the world is forced to return to a solvent, asset-backed monetary standard. Now, we present the clips from Andy Schectman's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Central banks don't buy gold because they're emotional, first and foremost. They're not catching the trend. They buy it because it's nobody's liability. Gold didn't overtake the euro because it's shiny. As far as I'm concerned, gold is doing what it's doing by default because there is no replacement for trust, period. And I think that's what it comes down to. And when you see interest costs exceeding defense spending, you can see that the system has chosen its path with it, which is debasing, printing, inflating, whatever the hell you want to call it. But this is why central banks are buying gold. This is why silver is being drained. And this is why the paper promises are BS, and they're starting to show up as such. And now let's just talk about a few other things. Going back to the financial advisors, I hear this a lot lately. You need to sell. They're looking at the charts. They're looking at the ratios. They're looking at the headlines, the ETFs. They don't look at the deliveries. They don't look at the lease rates. They don't look at backwardation. They don't look at who's shipping the metal out and who's buying it in. Where is it going? By the time this system admits stress, the positioning opportunity is already long gone. So I don't know. I just wanted to say that. Let me see. Do I have anything else here? TD I talked about. Oh, there was an interesting report in the written by Van Eck. Did you see that? Financial Advisory. They said if the dollar loses reserve status. Now, what have I been saying? I've been saying it is my belief that they want to soft default on the reserve status. It's what they want to do. They want to no longer be the world reserve currency over time in order to bring back manufacturing. Triffin's dilemma says you cannot do it if you are the world reserve currency. Vice President Vance has written about it, talked about it. Jared Bernstein, the knucklehead from the chief economic advisor from the Biden administration, wrote a report, Dethrone King Dollar. It is very much well known. If you retain world reserve status, you will never have a trade surplus. And I think that's where they're going. We've talked a lot about that. I mean, I've gone over it copiously on many podcasts, but Van Eck comes out and says, if the dollar loses reserve status, gold could surpass $39,000. And it says, what if gold replaced the U.S. dollar as a reserve standard? In this paper, our emerging markets bond team values gold by matching central bank money liabilities to gold reserves, implying a $39,000 to $184,000 per ounce price target for gold. And if they were to divide central bank MO, which is the most immediate form of money in the system, they come up with $39,000. If they use M2, it's $184,000. So anyways, bottom line is you got a mainstream financial advisory saying, well, what if? What does that mean? I don't know. When people hear that it's James Rickards doing it, that goes in one ear and out the other, and out the other. I wonder what they'll say when Van Eck is doing it. When you give up physical possession for convenience, you're going to regret it. You're not going to get the same thing back. Now, the reason people hold PSLV and PHYS aside from the fact that Eric Sprott and the name Sprott is the top of the food chain, and certainly a whole hell of a lot better in my mind than holding SLV and GLD, which I consider to be the worst products I've ever seen, is that it's a closed-end fund versus an ETF, meaning that you are eligible for regular capital gains, not the collectible capital gains rate that you find with with SLV and GLD. So certainly you wouldn't want to do that. But look, when people are thinking, what should I do? Should I own PSLV, third largest stockpile of silver in the world or so, held by a great company, metal stored at the Royal Canadian Mint? Well, number one, I can take possession of it. Okay, in 10 1,000 ounce bars minimum. And the management fee that you're paying is between 40 and 50 basis points. I believe you could store physically in a Brinks facility for less than that. And the storage in a Brinks facility is tax deductible. It becomes part of your cost basis. If you spend $100,000 on gold and silver and have a $1,000 storage bill, your cost basis becomes $101,000 after the first year. So not only is it less, the storage rate probably going to be less than the basis fee that you're paying Sprott to begin with in terms of annual fee, maintenance fee. You get the ability to stand for physical delivery, and it's tax deductible. But yeah, I think that in general, paper, if you're going to own paper in the form of mining or gold and silver, make it mining shares. Don't skip on, don't look at the inconvenience of holding the real thing, an excuse to buy, a paper supplement. In fact, the fact that there is no counterparty risk and you hold it yourself is, to me, the key benefit in a world that is becoming increasingly less private and much more digital. You look at the technology that is embedded in the stablecoin bill. You got AML, KYC, and KYT compliance, where it's anti-money laundering, know your client, know your transaction. They'll know what you're doing, who you are, and where the money came from. So having something outside the system as a legal, tax-paying, law-abiding citizen ain't a bad thing. So, and if you watch The Great Taking and anything that is securitized, what that means, man, I wouldn't own that stuff with a 10-foot pole. I would own the real thing, whether I store it in a vault, in Brinks, or bury it in my backyard, or do whatever with it. That's my business. I would say you're better off having that slight level of inconvenience. But in the end, I think its benefits massively outweigh the drawbacks.
The erosion of the dollar's reserve status may be a calculated soft default designed to resolve Triffin's dilemma. In this paradox, the issuer of a global currency must trade deficits that eventually undermine its own manufacturing base. While policymakers potentially steer toward this outcome to reindustrialize, mainstream financial advisors remain fixated on nominal price charts, missing the critical signals of physical stress, such as backwardation and soaring lease rates, that indicate a decoupling of the paper and physical markets. Central banks are ignoring these technicals entirely, accumulating gold solely because it is nobody's liability, essentially replacing trust with collateral as U.S. interest expenses surpass defense spending. In this environment, relying on paper promises via ETFs or securitized products exposes investors to the risks outlined in The Great Taking, where legal frameworks prioritize secured creditors over asset owners during insolvency. True sovereignty requires holding metal outside the digital grid, bypassing know-your-transaction surveillance and counterparty hazards. While physical possession entails storage logistics, this is not an inconvenience, but a strategic necessity, converting wealth into a tangible form that exists independently of a financial system increasingly defined by insolvency and control. Let's get back to the interview.
What we're watching in gold and silver, to me, if I could break it down easy, it just seems to me the ending of a paper-based pricing system that's colliding with a form of physical reality. And I can't see how this ends quietly. And, you can see also what's happening when people seem to think that these banks have unlimited power. And if you've been in this game long enough, it feels that way. And when you see a major bank like TD Bank shorting silver in a market this tight, it tells me one thing. It tells me they're trapped and in a system that ultimately is making them pretend that supply exists when it really doesn't, because TD Bank put on a trade, a big short trade. And that short trade, in fact, it's very silly to short something that's backward dated like this is. In other words, you're shorting something and the traders are paying a premium to have it right now. To me, and something that was just classified a critical mineral, the only reason you'd be stupid enough to do that is because you have to. And the funny thing about it is that they sent out a report saying we think silver's going to like 45, and they just recently got stopped out at 92. In other words, they had stop losses put in place to get them out if it went the other way, and they lost a good amount. I don't know, couple $100 million or something. I don't know what they lost, but that's not the point. The point is that they sent out a letter saying they thought it was going the other way. They got stopped out. This was forced buying, and this is how accidents start, because you're stupid as hell to short something naked in a market that is in backwardation. And I think that, you look at what we've seen along the way, how these banks that are somewhat trapped are trying to change things to get the price back down, but they can't do it again. Even when they dump paper in the dead of night, when liquidity is the lowest and the price goes down, we see physical stress going back up. And in other words, every time it goes down, the physical's being bought. December was the largest delivery in the history of the COMEX market for the month of December. Somewhere in the neighborhood of like 68 million ounces of silver were delivered. That's not bearish, anything to say the least, for the people who saying that the top is in. And I think when you talk about all these people, the talking heads that tell you that the top is in, like TD Bank or the Jim Cramers, the part that these people miss is that even as the paper price fell, the lease rates exploded higher. To me, that's the tell. And when it costs more to borrow real silver, the market is screaming, we don't have enough metal. These lease rates are normally 1/4 or 0.5%, not 8 or 9%. When you put backwardation in, that seals the deal to me. That means don't promise me silver next month. I want it right now. And that only happens when trust breaks. And for all of the people out there who are being told that this is the top, this is just like 2011. 2011 was leverage and speculation. Right? And you had traders that were speculating with leverage, and when they raised the margins, they all got kneecapped. Here they raised the margin the day after Christmas by 30%, and it doesn't do anything but just a little speed bump as the big money comes in and buys the most, or stands for delivery, the most that's ever been delivered in the history of the COMEX market since 1974. So it's not working. These people don't trade on margin. These big sovereign wealth funds and, governments and Teslas and Samsungs. And today is not about leverage and speculation. That's the speed bump. Today is structural shortages across the world, a declining mine supply 6th year in a row, exploding industrial demand. We see that everywhere, especially with AI and photovoltaic and all the way down through military and everything else that we've covered copiously. But it's the sovereign and the industrial buyers competing for the same metal where it's now critical. And I think that's something to me where, the people who analyze the markets and tell you, like your financial advisor, this isn't a trade, this is infrastructure. And I think you don't permanently top when supply is shrinking and demand is growing.
The precious metals market is currently witnessing the terminal phase of a paper-based pricing system as it collides with physical reality. The recent behavior of major institutions, such as TD Bank shorting silver in a backwardated market, signals desperation rather than strength. Shorting a critical mineral that traders are paying premiums to secure immediately suggests that these banks are trapped, forced to pretend supply exists to maintain liquidity. However, this strategy is failing. Despite margin hikes that would have kneecapped speculative leverage in 2011, today's market is driven by sovereign wealth funds and industrial giants like Tesla and Samsung, who do not trade on margin. This divergence is most evident in the explosion of lease rates to 8 to 9% compared to the normal fraction of a percent. This surge, combined with the largest December delivery in COMEX history, approximately 68 million ounces, confirms that the top is nowhere near. Unlike the leverage-fueled rally of 2011, the current move is underpinned by structural shortages, declining mine supply, and skyrocketing industrial demand. In this environment, silver has transitioned from a speculative trade to a critical infrastructure, meaning price suppression mechanisms are no longer effective against buyers who demand physical delivery. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.